Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending May 5th, 2023. I'm Preston Britton. Thanks for tuning in. This week's theme is, well, who's going to win this battle? The Feds, US Feds, or the bond markets? We'll see over the next 90 days just how it's all going to shake up. But first, let's take a look at what happened this past week. Kind of see how things are shaking themselves out here. So you can see here that it was generally every index was in the red with the exception of NASDAQ. Year to date, everybody's solidly in the green. You can see on the right-hand side, the forward PE ratio is still at 18.48. I still think that's higher than it should be right now, given all the risks that are out in the markets. The earnings yield for the S&P is at 5.35%, and the yield over the 10-year Treasury is still about 196 basis points. And the real yield is now in positive territory with inflation still at about 5%. Current VIX was up for the week. The prior week, we actually got it into the 15s. This week, it was up. I think for a day or so here this week, it was over 20, but it came back down and closed the week at 16.69. And you can see the best performer for the week, technology, just barely in the green. The worst was energy, really had an ugly week. Communication services is still leading the way annually, and energy is still bringing up the rear. And that's the exact opposite of what happened in 2022. Communication services brought up the rear. Energy was leading the way out of the gate last year, the first week of the year, and energy never looked back. So we're having a little bit of that kind of bounce here that we're seeing. Part of this week ended lower on comments from our Fed chair, Powell. He suggested that a pivot to cutting rates it might not occur as quickly as the markets hope. That's the battle that we're seeing right now with the bond market versus the Feds. Bond markets are given almost 100%. Nothing's 100%, but it's close to it. That the Feds are going to be forced to cut not once, but twice or even three times at the end of this year. Powell is saying that's not going to happen right now. And then we got Janet Yellen. She's the U.S. Treasury Secretary. She wrote a letter basically to Congress saying that the U.S. might not be able to meet its debt obligations as potentially as early as June 1. That would be the X date. So that's going to add another level of risk as we start moving through the month of May here. And the prior weekend, we saw regulators take control of another regional bank that was First Republic Bank. And pretty much like Silicon Valley Bank and Signature Bank, all of them are just having huge issues with large deposit outflows. You can't really blame them. Who wouldn't want to take a 5% guaranteed, almost risk-free rate or short-term treasury versus leave it in the bank that may go under? Okay, JPMorgan came in and bought them, of course, and they're going to cover whatever deposits are there, but they're going to share the risk with the U.S. Fed. So in a way, it's kind of a buyout with the U.S. markets or the U.S. Treasury involved in that whole thing. And, as a result of all this mess this week, the regional bank subsector in the S&P 500 had a lot of volatility. It was down about 10% for the week. So I think when this thing starts to get an all clear, there's some really good buys out there, I believe, in the regional banking sector. Members will go through it this Sunday evening. I still think there's some pretty good buys out there. Of course, everybody throw the baby out with the bathwater. Everything is going down. Okay. We did see this past week from an economic data perspective, the JOLTS report, the job openings report, third consecutive month it shrank, but there's I think about 9.6 million job openings. I think there's like 1.6 job openings for every unemployed. So the labor market still remains tight. That's going to be a problem with our Fed chair, Powell. Non-farm payrolls also surprised everybody this Friday, showing a lot of strength in the labor market. They added 253,000 new jobs in April. The consensus was only 179. And in March, I think 165,000 jobs were added. So this was a huge move up for the month of April. Average hourly earnings also increased 50 basis points month over month. That's another big hit. That's going to, really screw with the timetable of the Feds on when they're going to pause their rates, because now it's probably a 50-50 shot whether they do another rate hike in June or not. So that's still on the table. And as expected, the Fed did increase their rates by 25 basis points this week, right? They took the Fed fund target range to 5 to 5.25%. And during the press conference, Boom Boom Powell, he did hint that the Fed funds rate might be near the peak. So he did indicate that, but he said, I'm going to keep the options open for further monetary tightening, right? And he did make a comment during that press conference this past Wednesday that said a decision to pause was not made today. And then he said rate cuts would not be appropriate. So that gave them that changed the mood a little bit in the markets. That along with regional banks. So just really all in all, mostly a down week, as you can see, and the Nasdaq managed to just finish flat on the week, just slightly in the green. Of course, if we come over to Europe, take a look at what's going on over there. Just about everybody but the German DAX was in the red for the week, solidly in the green for the year. The ECB raised their key deposit rate by 0.25% as well to 3.25%, and they've raised their rates 3 times this year. So they're still behind the Feds as far as just how high they go, and I think they're going to have to go higher for several more meetings. Right? The bank said it would halt its program of reinvesting money. About time they do that. Their stimulus program, they were still doing stimulus. I couldn't believe that. But they're going to stop it in July. And the ECB president there, the equivalent of our Boom Boom Powell, federal Fed chair Jerome Powell, the ECB president Christine Queen Bee Lagarde, who used to be the president of the IMF, she's now running the ECB, said that interest rates are going to have to rise to a sufficient restrictive level until inflation is reduced to their 2% target, much like the 2% target here with the U.S. and the Feds here in the U.S. Meanwhile, in Europe, we did see inflation in the Eurozone accelerate, right, in April. So it actually went up. So she's going to have more pressure, and I think she's going to have to get a little bit tougher in raising the rates. So their inflation rate in the zone is about 7%, higher than it is here in the U.S., right? Granted, the U.S. has raised the rates a lot more. We're in a more restrictive territory than Europe, but I think they're going to have to get more restrictive as well. Okay, so, and they got a tight labor market. Their jobless rate has fallen to about 6.5% unemployment rate, but it's still a lot looser or a lot tighter than where we are here. They're going to have to do a little bit more work there. Meanwhile, you can see over in the Asian markets, the Nikkei, China, and Hang Seng, a lot of the Asian markets were closed for a good part of this week, right? Japan's market is relatively quiet. Went up the first couple of days of the week, but it closed Wednesday, Thursday, and Friday for their Golden Week national holidays. Their currency, the yen, is supported by kind of a safe haven demand amid the potential fears of a U.S. recession. So and for members, I'll go through with you my thinking on the yen, the dollar, and the euro, because I think those things are going to be some interesting plays as we move through this year. Those currencies are going to be interesting plays. Okay. And the Chinese equities, you can see just barely in the green for this week, like the Nikkei. But China, like Japan, they had a holiday shortened week as well. Although we got weak manufacturing data out of China. Okay, their PMI data fell to 49.2. Anything below 50 is contraction. And in March, it was 51.9. And that shows there is going to be a coming slowdown in the markets here. Because remember, everything that China exports, who are the buyers? It's Europe and the U.S. So when the buyers stop buying, the issues are in Europe and the U.S. China is just reflective of not shipping as much. So we're going to have a slowdown here as we go through the summer months into the early fall season here in the United States. So that's why the bond market is forecasting rate cuts, because Boom Boom Powell is going to be forced to because of the situation with the economy and a possible recession. But Powell right now is steadfast, holding that they're not going to cut rates. So that's the battle we got. And typically the bond market wins the battle, not the Fed. Short term, the Feds can win, but longer term, the bonds usually win that battle. So anyway, we got the weak PMI data out of China, and they did get they abandoned their zero COVID policy this past December. So they're still coming out of that, and their services PMI softened like the manufacturing PMI, but it just barely finished over 50, just barely. So the markets are slowing down. And, Boom Boom Powell here in the U.S. has got that conundrum. He's raising rates in a slowing economy with high inflation. Now, they put us in this situation to begin with, but I could talk for an hour on all the things they should not have done that they did, but it doesn't really matter. We're where we are right now. I want to show you the couple of key charts here. So let me just move my screen over, and we'll take a look at the E-mini S&P 500 futures on a daily chart. And you're going to be able to see we've really, going back to February, we're kind of around February's prices back over here when we're hit the high. But I think we're running out of juice up here. You can see that key fib node, that 23.6% fib node around 41.74, call it 41.75. And then the high point for the year that was made on the 2nd of February when the S&P, now these are the futures, it was up a little over 6% at 42.08. And you can see how this market seems to want to just curve back down again. I had said when we hit these levels up here, we're going to come down and test this zone down here. Well, now we're doing a double test. Should this hold up, we should chop around here and move a little bit higher. But if it gets weaker and we take this zone out here, which is about 40.80 down to 40.50, should we take it out, next stop down is going to be the 200 EMA, sitting down around 39.85. Let's call it 4,000, that zone there. Notice we fell through the 50 EMA here, this red line, and we immediately had a strong Friday close to take it back out. I think some of that was because the regional banking sector had a good day on Friday, and I think the regional bank sector is what's controlling some of this on again, off again market right now. All right. So that's a little bit about what I'm seeing there. If we look at the Dow, let me just find this. Here we go. Look at the Dow futures. It was up 537 points on Friday. But look at it. We were in the red on Thursday, and then we moved back into the green. Everything above that blue dashed line is the divider between being in the green and being in the red for the Dow futures. And we climbed back up, but just barely. Okay. And our high here for the Dow for this year is not very impressive. It's only 3.71%. We're not up there now, but that high was made on the 14th of February, Valentine's Day. And then we've just gave it all up coming into early March. Okay, it was down a little over 4.8% when we hit that low there. And now we're just kind of moving it back up, and now we're in a chop mode. But let's look at NASDAQ. NASDAQ's very strong. NASDAQ had a strong day on Friday. We're near the highs for the year for NASDAQ, okay? You can see here, now this is the NASDAQ 100 futures, and there's something that you got to understand about the NASDAQ 100 futures. First of all, everybody knows there's 100 stocks in here, okay? But out of those 100, 4 or 5 stocks drive about 44% of the value, and that would be the FANG stocks. Now, NASDAQ 100 futures are up near its high, which was made on May 1st, by the way, up around 21.08%. Okay. And if we look at it, you can see here that we're well clear of the 50, well clear of the 200 because the FANGs are doing so well. And if we look at the FANG index, right, this is a custom index I made of just the FANG stocks. You can see their high point for the year was up 41.66%. Now, if that weighting was 44% roughly of the NASDAQ 100. That's why these guys are so strong. And I said when we had that gap up, we're probably going to fill this gap. And I still believe it came back down to where it gapped up, but I think it's going to come back down a little bit more here. Okay. And then the other one that's just not doing good at all is the Russell. Let me just find the Russell on here. Where are we? I know you're in here somewhere. Here we go, right here. If we look at the RUT, it had a really good day on Friday, but notice we're still in the red for the year with the RUT. All right, we hit a low in the RUT on March 24th. All right, down 4.17%. We're still in the red for the year on the RUT, as I showed you earlier on the other screen on that slide deck. Still in the red for the year, and you can see the 50s cross back below the 200 again. Now these are EMAs, and that's going to serve as overhead resistance here. But I want to show you a really interesting chart. This is the equal weight SPX, okay? And if we look at the equal weight SPX, let's see, where are we? Here we go, right here. Look at this. Now, this is barely off of zero, Okay, almost looks like the Dow. We were in the red on the equal weight SPX. What that means is every stock, roughly 500 stocks, give or take. Sometimes it's 498, other times it's 502 until they get all their acquisitions settled up. But let's say 500 stocks in the S&P. If every one of them was only 1/500th of a percent, so everyone had an equal weighting, that's what this chart would show. But as we know, Microsoft and Apple and all the FANG stocks, Google, Amazon, all of those, they account for about 15 or about 16, 17%, 15% of the S&P. Just two of them, Apple and Microsoft, are about 12, 13% of the S&P. Huge, huge weighting. You take those out and make everybody equal weight, and the markets are going nowhere. We were in the red, believe it or not, on Thursday. So unless you own any one of those fangs, you're not having a good year. Everybody's pretty much flat to underwater. Okay. So just understand what the market is showing right now. Okay. And if we look at this ETF, it's an all world index, right? Um, I got to recalibrate this to the highs and lows. We're near where it was back in February, near the highs, but the highs aren't not that strong. It's not very good, right? The equal weight all world index. So if we come down here and we take a look at vol, let's just take a look at the VIX. Friday, it came down pretty good bit, 2.9. Look at that. You see where it gapped up. We had an intraday in the VIX of about 2134, and we came all the way back down. We had an intraday low of 1677, and then we settled near the lows. Okay. Um, so I knew when we got down here, with these lows we haven't seen since the fourth quarter of 2021, you're going to have a little bit of a jolt to the system. I think we're going to see another jolt in this system in May going into June. We got a little bit of a dangerous period coming up here with the markets. And I want to see now, next week, we're going to get the CPI data and PPI data. So we're going to get another hit on inflation. All right. And then we're going to take a look at the core number and see how that's holding up. Because again, the Feds follow that very closely, and we'll see what's going on with it. And if we look at the front month skew, the front month volatility skew, it should be in the green, which shows that it's a contango skew, which is a normalized skew, not a skew with a lot of fear. And if we look at the back month skew, it's going to be in the green as well, much deeper in the green. So there is no fear there. And then if we go to the 2/8 spread, which is the June versus December volatility skew, you're going to see this one is also in the green. So we do not have much fear going out in time right now. And I think the markets are underpricing some of the issues that could be surfacing here in the next 60 days, primarily the budget deficit and raising the budget ceiling. I think that's going to be a little bit of a scare the children moment. I still think regional banks are not lending, so the economic fallout from that's not going to be felt until Q4 of this year to Q1 next year. And if Boom Boom Powell is forced to cut rates at the end of the year, like the bond market is saying, well, that means the economy's not doing good at all. No growth. So these are some of the things we're going to be watching out for. Members, we've got a couple of really interesting plays that we can put on because of this. Like if we look at the bond market, down hard on Friday, over one full handle, which means interest rates moved up. Okay. I believe the bond market, to believe the bond market, let me say it another way, to believe the bond market, that would imply that the rates are going to come down, meaning Boom Boom Powell is going to be forced, the Fed's going to be forced to cut the rates Q3 and Q4 of this year. All right. I even saw some forecasts where they're looking to cut the rates by June of this year or July of this year. I don't see that happening. I do see one or two 25 basis point rate cuts towards the end of the year. Okay. And credit's going to be very tight. Regional banks are going to snap shut. They can't afford this. And it's going to work its way through the economy, guys. That's kind of what I'm seeing. And if we look at the 10-year rate, you'll see it moved up a little bit on Friday, right? Still down low. We got the 50 crossing the 200. The rate was up over here. I had called a high point in the rates way back earlier this year, back when the rates were coming up. back last year in Q4, I'd said the high was going to be around 4.05. We actually hit 4.33, and then we've just been working our way down since. Choppy, but coming down, right? And that's the bond market saying that the Feds are going to be forced to cut in the latter part of this year. Okay. So that's kind of that's the battle that's going on right now. And of course, if we look at the dollar, you can see the dollar index. Well, let's get this on the screen here. You can see the dollar is coming down. My target for the dollar is still down here around just slightly under 100. That's a big support area for the US dollar. Should that break, then the euro is going to take off. I think it's going to consolidate down here for a while before making another move. And the euro, we've had two entry points for the euro. It finished flat for the day, but we had an entry point way back over here in Q4 of 22, right? Got into the euro when it was about 1.01, rode it all the way up. Some of our members made a lot of money in this thing. A little bit of a pullback. There was another entry point back over here on March 22nd, and it's still running right now. I don't think there's too much more upside here. I think Great Britain, or not Great Britain, but the Eurozone is going to have some issues here coming up in the summer months. So we'll see how this shakes out. But my target for the euro is up here around $1.11. We're getting close to my target right now. Okay. Now let's talk about the yen for a second. The yen, they've got this yield curve control. They call it the YCC program, where they're trying to maintain the yen in a certain range. But with the U.S. facing a recession, keep in mind the yen is a safe haven for currency. So that's going to push the yen up. And I'm projecting the yen to move up from here. It's going to be choppy, but I do believe it's going to be more bullish than bearish. So the risk of a bigger move in the yen is to the upside. So for our members, we've got some strategies that you can deploy, whether it's the euro or the yen, for these kind of trades, and they work out very well. Okay. And then, of course, if we come over and look at gold, I think near-term gold is going down. Friday had an ugly day, 30 points down, right? I got a market, but we came up almost right to the all-time high that we made on August 3rd of 2020. Almost up there, right? That was on May 4th. So that was the intraday high point, and now we pull down hard. I got to adjust the screen here, adjust the reading on it. But that's a little bit about where we're sitting right now in gold. I do believe it's going to come down and settle down here for a month or two, and then it's going to move up. Remember, with interest rates moving the way they're moving, and with the Feds, if we do have a recession, traditionally gold should be strong. I've been bullish gold long term, not short term. There's a lot of in and out swing trades that you can do, certainly day trade, but longer term through the course of this year and the next year, I'm bullish gold, right? So I'm using essentially the buy the dip mechanism with gold to play it that way. Okay. I mean, that would be the best way to play gold in my mind. Silver's the same, right? If we take a look at silver, it came down not as hard as gold did on Friday, but you can see it made some higher high here. So silver's playing catch up, because this entire period here where silver was flat for 2 months, gold was moving higher. And then gold gave it up, silver gave it up. And then we've just really since March 10th of this year, silver's been on a tear. So you're going to see a little bit of a pullback, and you're going to use that as a dipping opportunity to buy. That would be my play on silver. And if silver moves, it's got a higher beta than gold, so it tends to move faster. But we got a couple of different ways that we can play silver in the options market and the futures contracts, which is a really good way to play these guys. Oil, well, oil just had an ugly week, as you guys know. You can see it made new lows here on May 4th. It was actually down 20.95% intraday low in oil on May the 4th, right? Which is a Thursday. And now we're probably going to move up a little bit here, but this is a really great opportunity to put our type of trade on. You can see even bullish, it hasn't been up more than 3.75%. Relatively low. All this is just a lot of noise going nowhere. So it's a great way, the way that we trade oil makes a lot of sense to play it that way. Nat gas, we've got some plays on nat gas that work out very well. Also, we got short nat gas over here and over here, made a lot of money in it. And then back down here, that was my target. We blew through it. As always, whether my target is a resistance or a support point, it always moves back and kisses my target pretty close and then continues in the same direction, in this case to the downside. I think there's the risk of a bigger move in nat gas now is to the upside, not to the downside, right? I just don't see too much more downside in nat gas. So there's some really great opportunities in nat gas, which I'll cover for our members Sunday evening. Okay, so these are some of the really interesting trades that we got going on. Also, I'll talk about some of our regional bank plays for our members as well. If you're not a member, I highly encourage you to come in. We're having a fun time making money as we did last year. And members, I'll see you this Sunday evening for our weekly market watch. Otherwise, have a really great day. Enjoy the weekend, everybody. Ciao now.